So right now we're going to do a financial markets update, and this should be a reasonably interesting one because a lot has happened since the last time we did one of these updates, and also a lot has happened just in the last month or so. So there'll be plenty to discuss. So we'll start with just a review of what has happened in the broader marketplace over the course of this year in 2025 so far, so year to date. So Mick, if you could just give me a scroll over this way, and hopefully all you who are joining us online can see this. We have a new camera, new hardware here, so we're just getting used to it. All right, so what I'm showing here is the market index performances for year to date 2025. This is I actually ran these numbers this morning, so these are as of the close of business yesterday. So there shouldn't be too much change from these until now. I think the market was down slightly earlier this morning, but nothing dramatic. All right, so let's start by looking at world stocks. So world stocks. Here we're using the FTSE Global All Cap Total Return Index, which is a measure, it's basically the broadest measure of stocks that includes U.S. stocks, international and emerging market stocks, large cap, mid cap, small cap, etc. So it's very broad, and that broad index is up 4.61% from January 1st until now. All right. Then we'll break it down further into subcomponents. All right, so you have U.S. large cap stocks, and here we're using the S&P 500 index. And the S&P 500 is now up 0.65% for the year. And after today so far, it may be closer to flat, zero. It's been in the negative for an extended period of time, and really only over the last 2 days did it pop back into positive territory. And we're going to talk more about that in a little bit. Next, we have the U.S. mid-cap stocks. Here we're using the S&P Mid-Cap 400 Total Return Index. And that index is still down 1.77% for the year. Then we have U.S. Small Cap, which is the worst performer amongst all of the broad asset types so far this year. Again, using the S&P Small Cap 600 Index, down 6.88%. Even though it's down 6.88% right now, that looks bad. You should have seen it a few weeks ago. So then we have, it just says IDM here. This is international developed market stocks. We're using the MSCI EFA there. And international development market stocks includes basically everything outside the U.S. that is has a developed exchange, or stock exchange marketplace. So we're talking about, we're excluding the emerging markets here. So we're talking about Western Europe, Canada, Australia, New Zealand. I believe South Korea is now included in that as well. Yeah, that's pretty much who we're talking about there. But that cohort has been the best performer so far this year. Right now, up 14.08%. Dramatic difference from what U.S. stocks have done for the year to date. All right, we'll come back to why that is in a few minutes, or why that might be in a few minutes. Then we have emerging market stocks. Here we have the MSCI Emerging Markets Index, up again similarly as a non-U.S. stock cohort, up 10.08%. Then let's talk a little bit about bonds. So we have U.S. short-term bonds. This is the Bloomberg U.S. Aggregate 1 to 5 year Total Return Index, which includes again, short-term 1 to 5 year maturities, but corporate bonds, agencies, treasuries, etc. So relatively broad for the short-term piece, but that's up 2.05%. U.S. aggregate bond includes everything I just mentioned, but not just the 1 to 5 year, but going out to 20, even 30 years, right? Is up 1.45%. and TIPS, or Treasury inflation protected securities, where we're using the Bloomberg US Treasury US TIPS index, 2.85%. And all of these numbers, again, are as of the close of business yesterday, so they're very much up to date. Okay, what's going on here? Why do we have such differentiation in terms of the results, right? Which is actually pretty different from what we've seen over the last few years. In the last few years, things have been pretty highly correlated. It's really just over the last several months that we've seen this relatively low degree of correlation or negative correlation, right? And a lot of it has to do with the dollar and with tariffs, right? Which are obviously the big buzzword. So why the dollar? So well, the dollar is being affected by a lot of different things. One of those things being tariffs, right? Or expectations for tariffs, or the outcome thereof. And typically, when you see a weakening dollar, which is what we have seen over the last couple months, that results in an outsized outperformance of non-U.S. assets, right? So that's these numbers over international developed markets. If you were looking at your results from Germany, for example, if you were in Germany, your results would not look as good at this as this unless you were looking at them in dollar terms. If you're looking at them in euro terms, they would not look as good as this. Right? So the dollar as having an outsized effect on the performance results, right? So, and it also makes U.S. stocks look worse, right? So that's one thing that's affecting this. That's making that international stocks look so much better than U.S. stocks. And when you talk about inside of the U.S., okay, what is affected most significantly by the dollar? It's going to be small cap stocks. That's why you see this like steady gradient in terms of the returns. With the U.S. large cap, roughly flat, mid caps down, a little bit more, and small caps down a lot more, because typically large company stocks derive a lot of their a much larger portion of their revenues from outside the United States, whereas small company stocks tend to derive a lot more from inside the United States, so they will be more affected by dollar fluctuation, right, potentially. And also not just by dollar fluctuation, but by expectations for economic growth and how that will affect their prospects, right, as a company. So those are some of the things driving those results. The other things I would point out is that, we've had this huge fluctuation, which we're going to get to in a few minutes, in stocks over the last couple months, whereas bonds have not moved much at all, right, since the end of February, right? And that is, again, kind of a reversion to like normal history, right? So for many years, really since the financial crisis, we've had this very, very highly correlated asset price movement, where all different types of stocks and all different types of bonds, they all move in tandem. They all move up and down at the same time, where modern portfolio theory tells us that you should have lower correlation amongst these asset types historically. And so when stocks go up, bonds go down, and vice versa, etc. You should see more of that. That has not been the case, in the last, almost, what are we talking, 15 years or so plus. Now we're starting to see that, this is more normal actually, right? Where we're seeing lower correlation in the movement of prices. So bonds have actually, during the most recent downturn in stocks, have been a really nice backstop, because they have not really moved much at all. They've been, they've gone up and down very slightly, but they've been in the positive for pretty much the entire year to date, where stocks have been all over the place. Okay, so that's year to date. Let's take a look back a lot further than that. So Mick, if you could kind of focus on this area here. So what you see here is a graph of, and obviously this is not exactly to scale, this is just hand drawn, but this is showing the results. This black line represents the S&P 500, just again gross movements of the S&P 500 index since January 4th of 2022. All right, going back that far. Why are we going back that far? Because that was the peak of the prior bull market, all right, to the one we just experienced. So going back that far, January 4th, 2022, we then had a bear market, which troughed on October 13th of 2022. So relatively short bear market, but then we had a rebound, right, or a recovery, I should say, that on July 27th of 2023, we had this questionable period where we had a correction of 10% or greater, and a recovery from that, something we call a wolf market, which is a period of heightened volatility with no real clear bull or bear trend, but quantitatively what it is, it's a period of correction of 10% or greater, but not 20%. And the recovery thereafter, back to the prior record. So that's what we saw here. So the recovery date was on December 8th of 2023. We had this wolf market. All right, I'm going to tell you why that's important in a few minutes. Shortly thereafter, it was not until January 19th of 2024 that we had an indication in arrears that we were actually in a bull market. At this point, when we had this wolf market, we thought this may be a continuation of this bear, right? A bear market being defined as a decline of 20% or more from cumulatively from a record price, right? So at this point, we still didn't know whether this might just drop back down and retest these lows or not, right? You never know these things until in arrears. You can't measure them until in arrears or confirm them until it's already been, it already happened. Right? But it was on January 19th of 2024 that we re-achieved the prior record from January 4th of 2022, and we knew that, okay, we're actually in a bull market. Bull market confirmed, right? From that point forward, we just kept going. Right? We had some, they're not really reflected in this graph here, but you have some hiccups along the way. What we did not have is a 10%, another 10% plus correction, right? And that's important because usually, if you look at history, the time between the trough of either a 10% plus correction or a bear market and the beginning of a new 10% plus correction or bear market is about 1.14 years. That's the average time. If you look at the entire history of the S&P 500 going back to 1950, right? So during this entire time period, we say, okay, we're watching, we're waiting, okay. We're thinking that a correction is coming, right? And why a correction and not a bear market? Because if you look at, again, looking at the history of the S&P 500, typically, well, first of all, let's look over here. If you look at bull markets from trough to peak, the range historically has been, bull markets have lasted on the low end 1.15 years, up to the high end 9.55 years, so a very broad range, but the average is 4.29 years, right? Similarly, in terms of results or returns, the low end, you've had positive 44.62%. On the high end, positive 341.05%, with the average being an additional 133.09%, or the total 133.09%, right? What we had up to this point, right, in February 19th of 2025, is a bull market that had lasted 2.35 years, so roughly half of the average, right? And had given us gains of 76.06%. So again, roughly half the average gains, right? So another thing is that historically you have these wolf markets, these corrections and recoveries, they run anywhere from 0 to 5 intervening corrections before you get a new bear market, with the average being between 2 and 3, right? So at this point we had only had one. So the expectation is, yes, and we are probably going to get a downturn, right? But it probably will be a correction of greater than 10%, but not more than 20%, right? What we ended up getting was so borderline between the two, between a correction and bear market, that it's almost comical, right? So what happened is, in the intervening time period before we get to that, we had something called an eagle market. So an eagle market is a period where you get trailing returns of 30% or greater without any intervening 10% plus correction, right? And we confirmed that eagle market ended on December 23rd of 2024. About 3 months later is where we reached our peak. So February 19th of 2025 is the current record price for the S&P 500 index.
Why does it end at 1223 as opposed to the eagle market? That by definition, why would it end on 219?
Because at this point, the trailing returns, this doesn't really reflect it, but there was actually a little dip here. So this is not exactly to scale. So the rate of growth actually slowed at that time period. So it probably should redraw this slightly, okay, to make it reflect that. But it was at this point that our trailing rate of return got lower than 30%. So it's no longer an eagle. Now it just turned into at this point, the assumption is we just resume the conventional bull market, right, rate of return, right? But instead what happened is on February 19th, which is almost dead on with our 1.14 years. I think we came out to like 1.40 or something like that, whatever the number came out to. On February 19th, we started this downturn. On March 11th of 2025 of this year, we hit the 10% drawdown mark, which looked like our correction, right? So we said, okay, all right, here it is. We were kind of expecting this, right? What happened is that after that we had further drawdown to exactly negative 21.35%. So and this is on an intraday basis. What's funny is if you measure this on an intraday basis versus on a closing price basis, on a closing price basis, if you only looked at that closing price data, there would be no bear market measured. It would be like 19.9 something, right? But if you measure it on an intraday price basis, using the intraday high from here and the intraday low from here, then you have a bear market, and you have a negative 21.35. So at this point, and we go by the intraday prices. We use the most accurate pricing data we can use. So at this point, on April 7th of 2025, right, which is I believe Liberation Day was April 1st, right? Liberation Day, April 1st, right? So during this, we had this massive slide in prices during that time period, which we hit the 20% mark on April 7th, and that also is the same day that we have the maximum drawdown so far. So it was we hit 20%, and then we went past it to 21.35%. We have not retouched those lows. What has happened since then is we have gone straight back up, like a rocket ship, right? So to the point where right now, as of close of business yesterday, we are down only 4.15% off of the February 19, 2025 record. So what does this mean? So we know at least that we have been in a bear market from February 19th up until April 7th, a very rapid bear market, right? The question is, what is this that has happened since then? Because we will not know until we re-achieve this prior record price, right, from February 19th, and we have not gotten there yet. So one of two things could happen, right? Either we re-achieve that in the short term, right, because we're not too far off of that, right? Or we go back down, and I should say there's three potential outcomes. We go back down and retest these lows and go down further and continue the bear market, right? And then the other option is we just waffle around here for a while in limbo land, right? Till till the market tells us what's happening, right? So this is a big question mark, what's happening right now, since from April 7th until now. But we have history to try to be our guide here, right? So let's bring that to over here, if you could, Mick. So, all right, as I mentioned before, bull markets trough to peak. We just established that the most recent bull market that we experienced was about half the length of the average bull market, and at about half the returns of the average bull market. So it was a short one, right? And now we have this borderline bear market. It's like a miniature, like a bear cub, right? It's not so far, right? It's kind of similar to the one we had in 2018. 2018 was something very similar, where we had a bear market just barely. We just barely broke the 20% decline mark on like the day after Christmas, and then it went back to prior records. And it turns out that if you look at the history on these things, that is actually relatively common, right? So what happens? So here we're looking at bear markets after indication, right? The time after from indication of the bear market, so the 20% decline mark is hit, until the trough. That's what this data represents here. All right, so what does it tell us? If we look at the history, again, on all of these instances, going back to 1950, which is as far back as the data goes, they have continued. The range is 0 days, right? Like in 2018, I think there was 1 day in 2018, right? Until the turnaround, all the way to 1.63 years until you hit the bottom, right? With the average being 4.61 months, so between 4 and 5 months. So we're talking about the time between the 20% mark until the bottom, right, of the bear market. And the average additional drawdown from that 20% down mark is about 16.56% additional loss beyond that, right? However, that's the average. About 50% of the time, right, these bear markets have turned around within 1 month after indication, right? And some of them, as I just mentioned, happen on exactly the same day or like the few days just following that, right? So some of these are you call them bear markets, but it's more like a really heavy, an extra heavy correction, right? So that's something to think about. And so far, that latter component looks very similar to what we're experiencing here this year, right? Time will tell, but that's kind of what it looks like. Okay, so keep that in mind. Now let's talk about probabilistic analysis. So another way that we look at financial markets and do this analysis, everything we've done so far is we call it historical market type data analysis. Another type of analysis that we use when we're looking at flexible portfolio management and tactically asset allocating portfolios is using probabilistic analysis. And the way we do this is we take a series of asset types that we follow regularly, actually on a daily basis, and we create probability distribution curves for those assets, looking at their returns and their risk over time, right? And we rate those or rank those asset types in terms of their over or undervaluation relative to their own historical averages, right? So it's probability-based analysis. Really what we're looking for here is we'll look at all these different asset types. We're looking at what are the returns over the last year, for example, and compare them to the returns of their entire history of their returns, and say, okay, if the returns in the last year are much greater than their long-term average, that would indicate that they're overvalued currently, right? Whereas if the returns were much lower than their long-term average over the last year, that would indicate that they're undervalued, meaning they're relatively cheap, right? So that's a simplistic way of thinking about it. And then we also, we compare them not just to themselves, then we'd actually rank them relative to other asset types, right? But If we do all of that, as of this morning in particular, strangely enough, both stocks and bonds of pretty much all types. We're talking about all the different types we looked at over here. These same 10 that we looked at over here. What do we have? We have 9 there. We're missing one more. But there are 10 types that we look at on a daily basis. Everything comes in at roughly fair value, is hovering around the fair value mark. So we define that as a plus or minus a half a standard deviation around the long-term average. They all come in at about that same level. So that's another indicator here. Okay, so summarizing all this, what time we got? So summarizing all this, we have a confirmed bear market. We know historically, didn't point this out yet, but if you look at the traditional definition of a bear and a bull market, it's very simple. After you have a bear, you have a bull. After you have a bull, you have a bear. They just alternate, right? And every bear market in history, in the United States anyway, has been followed by a bull market that re-achieves the prior record price and in most cases goes far beyond it, right? In terms of additional gains, additional returns. So keep that in mind. So the only question mark here then is, are we experiencing an extremely rapid recovery back to this prior record? Or is this a false or fake recovery that we're looking at that is now then going to drop back down and retest the prior lows, right? So this is the question mark. What is it, right? But the question mark doesn't really matter that much. I'm going to tell you why in a second, right? So the outcome or analysis is, in terms of stocks, right? In the short term, we don't know what's going to happen. Whether we go up or down from here, retest the lows, or go straight back up and hit the prior records. We don't know the answer to that, but the truth is it doesn't really matter, because the intermediate term outlook is still, to long-term outlook is still positive, because of the fact that we know that as long as you can wait this out, right, and it may not be a very long wait at all, right, we're going to re-achieve the prior record prices, and effectively, even if you missed this entire downturn, which we didn't, by the way, we actually did extremely well through this for our clients with our flexible strategies. I can talk about that more later. Even if you missed all of that, right, you still, if you were to buy today, any cash you were to deposit in your account, if all you did was buy the S&P 500, which is not what I would do, but if you were to do that, you would still be buying at a 4.15% discount to the record prices, knowing again that historically you're buying at a discount that, and then most likely you're going to re-achieve that prior record and go far beyond it, right? Again, looking at some of these numbers here in terms of like bulls from trough to peak, etc. Okay, so what does that mean for us? Really what it means for us right now is you need to be offensive. So, and being offensive can mean a few different things, which we're going to come to in a minute in terms of specifics. But as I mentioned earlier, another thing you want to consider is, your over and under weightings to various methods of investing that we use here at 4Thought. So we talked about strategic asset allocation, liability-driven investing, opportunistic investing, and selective or concentrated investing. So right now, what you need to think about doing, or what we are doing for our clients, is we are allowing overweights to strategic asset allocation and selective or concentrated investing, primarily because these are heavy on stocks, right? And stocks look like a good place to be at the moment, like as we spoke about. We are underweighting liability-driven investing, or allowing underweights to liability-driven investing, primarily because that is focused for the most part on fixed income securities, which do not look as attractive as stocks do right now. And in terms of opportunistic, the opportunistic piece of the portfolio was extremely useful during this downturn and recovery that we've seen so far. But from the standpoint of looking forward, that may not be the best place to be. You still want to have your full opportunistic piece and let it ride out to the, back to the prior record, but it's not something you want to, allocate a lot of new money to right now, right? In order to take advantage of the opportunities where they are now, you want to be thinking about, again, overweighting the strategic asset allocation and selective or concentrating piece. Okay, looking a little bit more granularly at the asset types to be investing in and where to have overweights or underweights. I mentioned earlier our probabilistic analysis process and looking at what is the cheapest asset type out there versus the most expensive. If you look at the cheapest asset types, you're talking about U.S. mid-cap stocks. And in terms of the most expensive asset types that you may want to underweight, you're talking about Treasury inflation protected securities and emerging market stocks. Okay. I talked about being offensive before. I mentioned being offensive before because of the intermediate to long-term outlook for stocks is positive. How does that work for income investors and growth investors? Income investors meaning they are people who are your clients who are taking withdrawals from their portfolio currently, right, in order to fund their living expenses. And for those types of investors, your options are a little bit limited, of course, but there are some options. One thing you can do is, at least temporarily, you can minimize just systematic withdrawals that you're taking from your portfolio. Thereby, you're leaving more assets at work for you in the market while we're still in this recovery period, right? And while you're doing that, you can really only do that if you've already built up some excess cash reserves, right? And that way you can, if you're taking less from your portfolio on a monthly basis, let's say, you can supplement that with any excess cash you may have on the sidelines right now to cover your living expenses. So that is an option if you have that at your disposal. For growth investors, you have a little bit more opportunity, right? One of the things you can do is max out, on the flip side, basically max out your systematic investing right now, either from earned income, right, or any cash you may have on the sidelines. Earned income going into either to your 401k or to taxable accounts, right, outside your 401k. That way, again, you're taking advantage of depressed prices. But an even better thing to consider is if you do have excess cash on the sidelines in terms of lump sums that are not going to be needed for short-term expenses that you may expect and that are in excess of your cash, liquidity reserve, of 3 to 4 to 6 months of living expenses that you may need in the event of losing your job, for example. Under that scenario, what you could consider doing is putting in 62.5% or more of your excess cash now into your invested portfolio, your diversified invested portfolio, with the remainder going in at in 3 increments of 12.5% over the ensuing 3 months. And why is that? Why are those the numbers? Well, it's because we're already a month plus after the 20% decline mark from April 7th. At that point, our algorithmic processes and decision rules told us, which is something we actually did for our clientele, to drop in 50% of any excess cash immediately at that 20% decline mark, with the remaining 50% to go in 4 increments of 12.5% each over the next 4 months. We're now another month out after that, so now it's 62.5% now with another 12.5% for 3 months, each of the next 3 months. Now, that's kind of like the more conservative approach to use here, where what you could do, because in this particular situation we've had such a rapid recovery, if you expect that for some reason, one reason or another, you expect that we may have further declines here, we may waffle around for a while before re-achieving prior records, then that's something you could stick with, right? If you're of the mind that I'm not that concerned about this extra, 12.5% over 3 months, because maybe it's not a really substantial sum of money of cash you're putting in, or maybe just you have a very long time horizon and you're not concerned about the short-term fluctuations here. at this point, because we're already, had a substantial rebound, you could put up to 100% of your excess available cash immediately and put that right to work. Because again, you're getting your 4.15% discount, which is not huge right now, but it is below the prior records. And again, we know that based on history that once you retrieve that prior record price, you're very likely to continue on to go, to the upside for a very extended period of time based on the history of bull markets. So no matter how you look at it, it's a buying opportunity now. Now, that being said, don't take anything I just gave you here as advice for you in particular. Anything I've discussed here, you need to discuss with your professional advisor before taking advantage of this or before acting on this to make sure it's appropriate for your particular situation, as always. So, hope this was helpful, and we'll see you on the next time. Thank you. Bye-bye.